Good afternoon. Our analysis, as always, focuses on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Recent data indicates that the labor market has softened, with job gains slowing, openings declining, and participation edging lower, partly reflecting reduced immigration. At the same time, inflation remains moderately above our 2% goal, driven by a combination of supply constraints, tariff-related cost pressures, and lingering policy effects. In assessing these conditions, the committee faces a challenging trade-off. Inflation, though elevated, has proven less responsive to slowing growth, while risks to employment have increased as the labor market cools. In support of our goals and considering the shift in the balance of risks, today the Federal Open Market Committee decided to maintain the target range for the federal funds rate at 4 to 4.25% and to continue to reduce our securities holdings. Looking ahead, we will carefully weigh the risks of doing too little against those of doing too much. The persistence of cost-push inflation and the uncertainty surrounding tariffs call for patience and flexibility in our policy stance. While inflation affects everyone a little, unemployment significantly affects a few. This highlights the importance of balancing our dual mandate as we navigate this next phase of the economic.
Real gross domestic product increased at an annual rate of 3.8% in the second quarter of 2025, following a decline of 0.6% in the first quarter. The rebound in growth was driven primarily by a decrease in imports, partly offset by declines in business investment and exports. Conditions remain fragile in the housing sector. Housing starts dipped in August, and home price appreciation slowed to 2.9%. Most private forecasts project real GDP growth in the range of 1.7 to 1.9% in 2025 and about 1.8% in 2026, representing a slightly more optimistic outlook than in the previous summary of economic projections. One factor weighing on longer-run growth prospects is the recent decline in immigration. Immigration historically contributes significantly to labor force growth and overall GDP, and lower inflows of workers reduce the economy's potential growth rate over time. Inflation remains above our 2% target, with total CPI rising 0.4% in August and 2.9% over the past 12 months, though still well above the highs of 2022. Core measures, which exclude food and energy, are running somewhat higher than headline inflation, indicating that underlying price pressures persist. The PCE price index, our preferred inflation measure, accelerated slightly to 2.7% year over year in August. Goods inflation has firmed recently, reflecting tariff-related cost increases, while disinflation continues in the services sector. Near-term measures of inflation expectations have moved up modestly on news of tariffs, as seen in both market-based and survey-based measures. Beyond the next year, however, most longer-term expectations remain consistent with our 2% inflation goal. In our summary of economic projections, the median participant projects total PCE inflation at 3% this year, declining 2.6% in 2026 and 2.1% in 2027, suggesting that inflation will gradually move back toward target over the forecast horizon. Today, we'll be covering 5 key topics. First, we'll look at inflation risks and examine the main factors driving price changes. Next, we'll discuss labor market risks, including employment trends and wage pressures. Third, we'll review the housing and financial markets, focusing on affordability and overall market stability. After that, we'll go over our projections for economic growth, inflation, and employment. Finally, we'll conclude with our policy recommendation and forward guidance, outlining suggested actions and the outlook ahead.
The real GDP rebounded strongly in Q2 2025, rising at a 3.8% annualized rate following a contraction of 0.6% in Q1. The Atlanta Fed's GDP Now model projects continued robust growth in Q3 at 3.9%. However, broader private forecasts anticipate a moderation in growth to roughly 1.7 to 1.9% for the 2025 calendar year. Key headwinds include ongoing trade tensions, political uncertainty, and easing labor market demand. These factors may weigh on aggregate activity, highlighting the importance of monitoring incoming data to assess the pace of economic expansion. Nominal personal consumption expenditures have been rising at a steady pace, reflecting sustained household spending. This persistent growth in consumer demand continues to support overall economic activity. The increase in nominal PCE is driven by a combination of underlying inflation and ongoing expansion in real consumption, suggesting that households remain willing and able to spend. Monitoring these trends provides insight into inflationary pressures and the momentum of domestic demand, which remain important considerations in assessing monetary policy. Net business investment continues to expand, though at a more moderate pace, reflecting elevated interest rates and heightened uncertainty. Firms are maintaining positive capital expenditures, but growth has slowed as businesses adopt a cautious approach to investment decisions. This moderation in investment activity signals measured confidence in the outlook and underscores the influence of financing conditions and economic uncertainty on private sector spending. Trimmed mean PCE is staying just under 3%, but CPI housing and non-core PCE both exhibit a modest rise from July. This, in conjunction with expectations of inflation remaining well above actual PCE growth, means we deem the upside risks to inflation to be high following a rate cut. Cleveland Fed's nowcast projects flat core PCE through Q4 2025. With this as our baseline expectation, we then consider the risk that elevated inflation expectations may become a self-fulfilling prophecy and anticipate core PCE inflation between 2.85 and 3%. Headline producer inflation has shown modest signs of easing, reflecting some relief in raw material and input costs. However, core producer prices remain elevated, indicating persistent cost pressures in downstream industries. While softening commodity prices suggest improving supply conditions, the pass-through of earlier cost increases continues to affect the prices of processed goods. This persistence in core measures suggests that inflationary pressures, particularly those tied to labor and distribution costs, remain embedded across supply chains.
The unemployment rate edged up to 4.3% in August, or about 7.4 million people, showing little net change over the past year, but gradual upward trend. New entrants among the unemployed decreased by 199,000 to 786,000 in August, offsetting an increase in the prior month. The slower pace of the unemployment rate highlights that the labor market is losing momentum as businesses have grown more cautious and the labor market has expanded only modestly. Next, let's look at youth unemployment. Youth unemployment rate among young workers aged 16 to 19 years old has increased faster than the overall rate, reflecting ongoing challenges in labor market entry. Recent data shows that while youth unemployment rate has eased from its pandemic peak, it's still slightly elevated compared to pre-COVID levels. This matters because youth unemployment often serves as a leading indicator for broader employment trends. Persistent weakness among youth workers can signal future slower job creation. The total separation rate across non-farm unemployment is holding steady at 3.3%. Within that, voluntary separations are relatively unchanged and layoffs aren't a clear upward trend. This tells us that separations are stable and we're not yet seeing widespread forced exits or panic layoffs. In other words, firms aren't shedding labor aggressively, which supports the notion that the labor market is still resilient. Job openings remain around 7.2 million, or 4.3%, as of August 2025. That's still high, but down from post-pandemic peaks. This shows that the labor demand is steady but cooling. Firms are still hiring, just more cautiously. The slowdown suggests that businesses are adjusting higher interest rates and softer growth expectations. Overall, job openings indicate the labor market is normalizing.
In the housing sector, financial conditions remain restrictive. The average 30-year fixed-rate mortgage stands at 6.34%, roughly double its pre-pandemic levels. The rise in mortgage rates reflects that previous policy tightening is still transmitting effectively and affecting consumer borrowing conditions. However, these elevated rates have continued to hold on household affordability, which we primarily see impacting first-time buyers. Housing prices have accelerated post-2020, and this is additionally driven by the supply shortages combined with strong demand for housing during the pandemic. Current levels indicate that housing is historically expensive. The mortgage delinquency rate on single-family mortgages remains historically low at 1.78%, reflecting strong homeowner balance sheets and responsible lending standards. This supports the view that financial stability risks from the housing sector remain contained, allowing the committee to focus primarily on the trade-off between labor market softening and persistent inflation. Corporate bond spreads have narrowed to 165 basis points, near the lower end of its post-pandemic range. This reflects stability in the corporate credit market, suggesting the Fed has room to stay restrictive or hold without causing major corporate credit distress. However, according to the Senior Loan Officer Opinion Survey, banks continue to tighten lending standards, particularly for commercial and industrial loans to large and middle market firms. This tightening serves an additional channel of monetary policy transition, effectively amplifying restrictive conditions without further rate hikes. Credit card delinquency rates have risen gradually to 3.05%, reflecting the impact of inflationary pressures on household budgets. Additionally, the national average credit score, which had been increasing for over a decade, has fallen for the second consecutive year to a current value of 715. While these changes signal that the consumers are feeling the effects of tighter policy, the levels are not indicative of financial stress as much as a return to normal credit risk.
Coming to the significant risk, the ongoing government shutdown is expected to weigh modestly on near-term growth. though historical evidence suggests these effects are temporary once operations resume. Approximately three-quarters of federal workers remain full-loaded, constraining public sector output and suspending key data release, including the employment report, CPI, PCE, and GDP. This data blackout limit real-time visibility into the economy, requiring heavier reliance on private sector and high-frequency indicators to assess current momentum. The 2018 and 2019 shutdown reducing real GDP by roughly $11 billion, of which about $3 billion was unrecovered. In the current episode, the near-term impact is likely to include a modest drag on consumption and confidence, partially offset by delaying spending once operations resume, while softer federal demand might temporarily ease inflationary pressures. Prolonged uncertainty could restrain hiring and investment decisions. Entering Q4, consumers are expected to bear an increased share of cost pressure as producers continue to pass elevated input expense through the supply chain. While firms have thus far absorbed the majority of these costs, this margin pressure is unlikely to persist indefinitely. The effective U.S. tariff rate reached 17.41% in August, the highest level since 1935. This further amplified import costs and reinforced upward price pressure on final goods. These developments suggest that consumer inflation might remain elevated even as headline producer inflation stabilizes. While inflationary impulse from tariff is likely transitory, representing a one-time upward shift in price level rather than a persistent acceleration, the near-term effects is to reduce real households' purchasing power until risk modesty toward higher good inflation, though year's end. Turning to artificial intelligence effect on labor market, we continue to view AI as both a near-term growth-driven and an emerging labor market risk. In the short run, AI-related investment remain a meaningful source of demand. The expansion of data center constructions and infrastructure development is supporting hiring across certain regions and sectors. At the same time, we're beginning to see relocations effect, where automation shifts employment pattern and reduce opportunity in more routine or entry-level position. In the long run, surveys evident point to a gradual adjustment in labor demand. The New York Fed report that about 12% of AI using service firms have already slowed hiring, nearly one quarter expect to do so. Similarly, the Dallas Fed found roughly 10% of executives indicate AI has reduced their need for workers. Taken together, these developments suggest that while AI will likely enhance productivity and capital spending, it is also pose downside risks to entry-level employment and may concentrate opportunity geographically as the technology matures.
After reviewing the full discussion and incoming data, the committee will maintain the target range for the federal funds rate at 4 to 4.25% and continue to reduce our holdings of Treasury securities and agency MBS. While core PCE has remained flat, in light of elevated inflation expectations and our recent rate cut, inflation does present an upside risk. On the employment side of the mandate, youth unemployment appears to be going into its usual seasonal decline, indicating U3 behavior in line with historical norms. U6, which includes discouraged workers, remains elevated, but is not moving any faster than U3. Job separations are also not increasing, meaning the labor market remains in balance and does not require expansionary policy support. While AI is already reducing some entry-level employment, it is also contributing to direct employment in the tech sector, and the short-run effects AI has remains uncertain. In the short run, AI has a net zero effect on our monetary policy decisions. Despite inflation risks and labor balance, financial conditions remain restrictive in the housing market as the burden of high mortgage rates falls disproportionately on low-income and first-time homebuyers, arguing for a less restrictive monetary stance. Tariffs and the government shutdown both present special risks to our monetary decisions. We anticipate inflation from tariffs to be transitory. However, if this proves not to be the case, we are prepared to adjust our stance accordingly. We anticipate the economic effects related to the government shutdown to be temporary, but lack of data will cloud Fed decision-making. We'll continue to monitor private data and high-frequency indicators until federal reporting resumes. As always, our policy remains data-dependent. We will assess the totality of the data, the evolving outlook and the balance of risks and stand ready to act to achieve our goals of maximum employment and price stability.